I'm Sarah Borkson-Keto here in Los Angeles for REITworld 2019, NAREIT's annual conference. I'm joined today by Dirk Alibar, Managing Director of Advisory and Consulting at Green Street Advisors. Welcome, Dirk.
Thank you. It's good to be here.
So according to Green Street's estimates, traditional sectors have been priced to deliver a 5.7 return this year on average, and non-traditional sectors have been priced to deliver 6.5%. What has caused this convergence compared to 2016 levels, and do you expect that to continue?
So the non-traditional sectors include self-storage, single-family rental, data centers, senior living, these sectors that really haven't had a spotlight on them like the major sectors have. And frankly, there's a lack of available data out there to really understand these sectors in a way that you can understand the major sectors. That's part of the reason we've seen a nice risk premium on these various companies. What we've seen in the past couple of years is we've seen institutional investors really move into these sectors in a quest for yield, and that's caused the risk premium to drop, and the interest is going to continue in our opinion. We're seeing institutional investors all over the globe focus on these non-traditional sectors because they like, even though the risk premium has shrank, there is still a risk premium relative to the larger sectors. The issue that we're finding and what ultimately I think could dampen interest on the long term is supply in some of these sectors. Self-storage would be a good example of where we've seen supply come into the marketplace and lower the long-term growth prospects. But generally, yes, we do expect the yields to continue to converge. Are they ever going to be on top of the major sectors? The answer is no. There'll probably always be a slight premium because they're just not as, the information is not as transparent.
And over the last 5 years, non-traditional REITs have traded at premiums to their asset values, while traditional REITs have traded at discounts. What does this mean for public and private market investors?
Well, let's take the public markets first. When we see stocks trading at premiums to their net asset value, what Green Street would say is we'd like you to issue stock and go out and buy those assets, those office products or whatever the asset type or sector it is in the private market. We think that's a good use of your capital. You're locking in value at that, when you're issuing stock above your NAV. When stocks are trading at discounts to their net asset value, what we'd like to see them do is ultimately sell assets at the private market value and go buy stock back or pay down debt. Ultimately, we feel like that's also another way to create value. This public-private arbitrage that we talk about a lot is very important and relevant to the companies. In the private market, when we see stocks trading at premiums, we expect values to increase in the private market. When we see stocks trading at discounts, we expect values to decline. This is not a rule that's been 100% true in history, but we do think that it's been true enough that it's something to pay attention to.
Dirk, thank you so much for joining us today.
Thank you, Sarah. It's nice to be here.
And for more on REITworld 2019, be sure to visit REIT.com.